Hey, it's Christy, and I wanted to share the difference between a 30-year and a 15-year mortgage when it comes to not only the amount of time you're making those mortgage payments, an additional 180 months worth, but also the cost that you pay by extending out that life of that loan to 30 years. And I want to give some tips on how to shave down that interest and pay less on that mortgage over time to be able to keep that money in your pocket and not have it go to the lender. So here we go. I've got an example here with a $300,000 mortgage, and I'm comparing a 30-year mortgage to a 15-year mortgage. Now, a 30-year mortgage is typically a higher interest rate than a 15-year mortgage, and in this example, I'm using a 5.5% interest rate on a 30-year versus a 4.75% on a 15-year. But all other things being the same, it's still going to be the same loan amount of a $300,000. I didn't change anything on like additional closing costs or anything like that for this example. And although the payment is higher every single month on a 15-year, what I want to demonstrate here is how much more it costs you by extending that loan out over time. And you can use this example for student loans that are in forbearance and deferment year after year after year. It's still accruing that interest and will still eventually have a repayment time period. The faster you pay off those installment loans, the better it is for the cost out of pocket. And same with auto loans. I see some people extending out their auto loans to 72 months so that they can have the most affordable payment that they can, but it's costing you a lot of money over time. So let's dive in. So on a 30-year mortgage, the principal and interest portion of the payment, so we're not including taxes and insurance, is $1,703.37 a month. And on a 15-year mortgage, it is $2,333.50. However, over time, I want you to know that if you go with that 15-year mortgage, you will actually save nearly $200,000 worth in interest, over $193,000 to be exact. It's crazy how much equity is built up by having that shorter period of time. And if you're not able to take on a 15-year mortgage payment, I completely understand. Here's my recommendation to you. Set up bi-weekly payments, which is where that loan servicer who you make your mortgage payment to every single month sets up basically an auto draft. So instead of paying your monthly payment on the first of every month like a good little borrower, you're going to set up an auto draft payment where they take out half of your monthly payment every other week. Let's say you get paid every other Friday. Align it with your payday. And so you're going to have half of your mortgage payment taken out every other week. What's significant about this is the math behind it. So stay with me on this. There's 52 weeks in a year, and if you're making a half payment every other week, that means you're going to have 26 half payments. 26 half payments equals 13 full payments. So divide 26 by 2, it equals 13. You'll have 13 full payments made in 12 months. That can shave off anywhere from 5 to 7.5 years worth of interest over that 30-year mortgage, making it, as short as a 23.5-year mortgage. It's pretty exceptional. The other thing I want to share with you is if you don't like the idea of auto drafts, some people don't like the auto drafts coming out of their account. They don't like the every other week. Maybe you get paid once a month. Maybe you have some bonus income that happens once a year, something along those lines. Then consider this, and I want to bring your eyes to this amortization schedule. As you can see, in the first just 3 months of the loan, the principal reduction equals $989.62 between those first 3 payments. So let's just round it up to $1,000. Let's say you made a $1,000 extra principal reduction payment before your first payment was even due, or maybe you just added it to your first payment. You just added $1,000 on that very first payment as a principal reduction to your standard regular payment. And let's say you did a $1,000 principal reduction on every single year anniversary. So when you went to go and make your 13th month payment, right? And then every year after that, let's say you added a $1,000 principal reduction. You are cutting out 3 months out of every 12 months worth of interest payments. So over a 30-year term, you're actually going to wind up with 90 months worth of prepaid interest, or divide the 90 months by 12 months to get your annual term, and that would shave off 7.5 years worth of payments, principal and interest payments. So you've now shaved 7.5 years off of a 30-year mortgage by just paying an extra $1,000 on your 1-year anniversary and every anniversary of your home origination, your home loan. So every annual anniversary of your home, just throw $1,000 principal reduction and shave years of interest off of that term. It could save you tens of thousands of dollars. It can help you build equity faster. Most people don't hold on to their mortgage for 30 years. They usually don't live in their house for 30 years. So as you can see in this example, it's very top heavy as far as interest up front. And that's not just a mortgage loan, you guys. That is on any installment loan. You pay the majority of interest up front, and then over time, it will flip sides where there's more going towards principal than there is going towards interest, but that's years down the road in most loans that are out there. So I encourage you to do this on your auto loans, on your student loans, on your mortgage, any kind of installment loan that you have out there. Find out if they will allow a principal reduction and if they will allow biweekly payments. Because if they'll do any of those two, you can shave off a ton of time and a ton of interest, keep that money in your pocket where you can go and put those dollars to compound over time for you. Put it into a retirement account, pay down other debts, have it as a safety net in your emergency savings fund. Build up your future by reducing your current debt load. If you have any questions, go ahead and send me an email at questions@creditchristie.com. Thanks for watching.